Don't count on the Fed to rescue the economy. Here's why. The Fed's September lowering of the Fed funds rate was greeted with widespread celebration on Wall Street. Yet, history shows that such moves by the Fed don't always translate into a glowing economy. Our monthly Elliott Wave Financial Forecast publication provides this perspective from its October issue. The August 2nd issue forecast the Federal Reserve's approaching rate cut, saying the Fed will lower the Fed funds rate commensurately with the lower level of T-bills. On September 18th, the Fed announced the 50 basis point drop in the Fed funds rate from 5.5% to 5.0%. By that time, the yield on the 3-month U.S. T-bill had slipped to 4.75%, and the yield on the 6-month U.S. T-bill was 4.50%. Now the yields have declined to 4.61% and 4.0% respectively, so the Fed funds rate is still lagging the decline in market rates. More important, the popularity of the Fed's decision continues to mushroom. In August, the Elliott Wave Financial Forecast discussed the positive vibe surrounding the potential rate cut, saying that it simply confirms that a bigger peak foreshadows an even bigger economic contraction. The cut itself stoked the optimism. 50 BPS, I will take it big, tweeted one of Wall Street's biggest commentators. On CNBC, a well-known investment banker lauded the Federal Reserve for creating nearly perfect economic conditions. Soaring hopes are a classic setup for the surprising failure called for in the August issue. At that time, we noted it should be a repeat of September 2007's initial Fed funds rate cut, which came 3 months before the start of the Great Recession. As we also illustrated then, the Fed was behind the curve the whole way, cutting rates continually into the final quarter of the contraction. This time, the effect of a turn toward negative social mood will be greater. Here at Elliott Wave International, we've seen this story before, and it didn't end how most people thought it would. Stay on top of the trends and opportunities in the U.S. markets. Consider subscribing to our Elliott Wave Financial Forecast today.